welcome to Macros with Mythili, our weekly show where we take a hard look at all the major macroeconomic developments in India and overseas. This week we're going to take a hard look at something that really defies understanding, not only in India but also in the world at large. We're going to try and make sense of macroeconomic fundamentals. Is the global economy recovering? Is there a new normal? If so, what is it? And who better to help us make sense of it all than Martin Feldstein, Chairman of the Council of Economic Advisors under President Ronald Reagan, Professor of Economics at Harvard University, and President Emeritus of the U.S. National Bureau of Economic Research. Welcome to the show, Professor Feldstein. How do you see the global economy? Are we out of the woods? Can we hope to get back to pre-crisis growth rates, or is that whole history now?
Well, I don't think you can summarize the global economy. The different parts of the global economy are behaving very differently. India looks like it has a good, solid growth rate. The U.S. is slowing down this quarter, but I think that's weather related. For the last several quarters, we've been growing quite well at 4 to 5%. Europe and Japan are still sick. So I don't think one can make a generalization about the global economy.
Is the U.S. recovery going to be sustained? Can the U.S. continue to grow for long if the rest of the world does not really recover? Can it be the single engine of growth?
The U.S. is, I think, likely to be sustained. After all, we are a relatively closed economy. Exports and imports are each about 15% of GDP. So what happens in Europe, what happens in China has a small impact on the U.S., but not a very large one. So I think that what matters here is our own domestic situation, and that's been pretty good. Real after-tax incomes have been increasing at a very solid rate. Last 3 months up at 6% in real terms. So I think, and the unemployment rate has come down to what is essentially full employment, about 5.5%. So I think we're in quite good shape from that point of view.
Do we have greater clarity in U.S. monetary policy now? You've argued in one of your pieces against the excessively slow pace of normalization, saying that it poses a risk to financial stability. So when do you expect to see the Fed raise interest rates? What is really holding the Fed back?
That's exactly right. I have an article in the Wall Street Journal making those points exactly. I am worried that having had essentially zero interest rates for 6 years and long-term rates that everybody recognizes are extremely low, that's causing all kinds of risk-taking on the part of investors and on the part of lenders that could lead to trouble in the years ahead. Why is the Fed not responding? I think, of course, the Fed is nervous that if they start to raise interest rates, the economy could slow down. More to the point, they're focusing on the long-term unemployed, on people who are working part-time, who would like to work full-time, and so they'd like to help those people. The trouble is that they cannot help those people without pushing the economy into an inflationary position and without causing interest rates that are very low, and that in turn has these effects on financial stability, which brings us to the first of your two questions. If you look at what's happening in the bond markets, we're seeing low-quality bonds having relatively low interest rates. We're seeing the stock market roughly 25% above its historic average relative to earnings. We're seeing banks making loans to high-risk borrowers. So all of that could become unwound. All of that could lead to serious economic problems if we're not lucky.
Are central banks all over the world obsessing about consumer price inflation at the risk of ignoring asset price inflation, especially if we look at the way stock markets have run up all over the world?
Well, I would say that these prices are bubbly. Particularly if you look at the fixed income part, the narrow spreads between treasury yields and lower quality corporate yields. I think there's a serious risk there. I think the stock market could come down to a more normal level. as interest rates rise. What is keeping the stock market high? What is keeping bond prices high? It has been the Federal Reserve's very easy policy, and they know that they have to normalize over the next couple of years, and if they wait, they're going to have to do it very quickly, and that could be destabilizing.
You've argued in the past that right fiscal policies could have achieved as much as unconventional monetary policy. But would that really hold for countries like India that already have a high fiscal deficit? In fact, that's been one of our biggest problems, that fiscal deficit seems to be high and there seems to be no way of restraining it.
Well, what I have argued was in the context particularly of Europe, that instead of pushing quantitative easing, or in addition to quantitative easing, they could have fiscal incentives, but fiscal incentives that didn't raise the deficit. So how do you do that? Well, for example, if you're going to have an investment tax credit to stimulate business investment, you could match that with an increase in the company taxation, increase in corporate taxation, so that there was no impact on the deficit, and yet there's an impact on the incentives that firms have to invest.
Between the two consequences of US Fed action, higher interest rates and dollar strength, which one is likely to hurt emerging market economies more, and what can they do to guard against the downside? This is particularly relevant for countries like India, which went through a very bad patch in May 2013.
Well, you know, what happens to emerging economies depends very much on how they manage their own affairs. Some of the emerging economies, and I don't think this is true of India, have allowed their corporations to borrow extensively in dollars. Well, that was fine when looked at in terms of the interest rate, but now what we're seeing is the rising value of the dollar, and that's increasing, particularly in Latin America, that's increasing the value of the obligations, the size of the obligations that those companies have, and they don't generate dollar earnings, and so they're going to be in trouble when it comes to repaying that debt. So I think countries can be careful about avoiding those kinds of problems, avoiding being tempted by low opportunities to borrow in dollars if that requires taking the currency risk. India's growth prospects are very much self-generated. I think the policies that the government in India are pursuing should make India a very attractive place, both for domestic investors, but also for international investors. So it's not just a question of capital flows so much as the equity investments and direct foreign investments. So being open more to foreign direct investment will help, and certainly the equity market in India has gone up very sharply in response to the hopes for the new Modi government policies.
Well, I'll have to interrupt you there, Professor Feldstein, because it's time for us to slip into a very short break. But please do stay with us. We'll be back very soon. Welcome back. You're watching Macros with Mythili, and we are discussing with Professor Martin Feldstein of the US NBR about the general state of the world economy, the Indian economy, and what can we hope to see as far as economic recovery is concerned. Professor Feldstein, before the break, we were talking about how EMEs are likely to be affected by anything that the US Fed does, and what can they do in order to guard themselves against a worse downside. There is a general belief that India is far better placed than other EMEs. Is that justified? Also, the world is now focused on deflation, but if we look at asset price inflation, we seem to be close to another bubble. So are we going to repeat the mistakes of the past by ignoring asset price inflation altogether?
I think you have to look at asset prices, and I think the deflation story is not a very persuasive story. After all, in the United States, the core CPI number is about 1.5%. And they say, well, we'd like to see inflation at 2%, but that's an arbitrary target. And why does it matter if we're at 1.5% or 2%? There's no real serious risk of sliding into deflation in the United States. And even the Fed is very clear that the impact of lower oil prices, which have temporarily brought down the overall price index, is just a temporary effect, and that will pass through the system. So if oil prices stop falling, the overall inflation rate will revert to the core inflation rate of about 1.5%.
Has inflation targeting as the ultimate goal and almost perhaps the single goal of monetary policy been discredited? If I remember right, as many as 32 out of the 46 central banks that adopted inflation targeting are now nowhere near their target. So what does this mean for inflation targeting?
I think it has been discredited. And I think inflation targeting used to have a very important role. When the inflation rate in the U.S. back in the early 1980s was more than 10%, when we had double-digit inflation, people were worried. And so it was important that the Fed said, we're going to bring the inflation rate down to a level where you won't have to think about it. It'll be so low. So that eventually became a hard number. People said, well, we'll get it to 2%. But to me, the real risk is not whether it's at 1.5 or 2, but whether it starts on a path that rises rapidly to the kinds of inflation rates we had back in the early 1980s and the late 1970s. That's what inflation targeting should be about, not a precise low number that is really quite arbitrary.
Post the global crisis, where we've seen fiscal and monetary authorities work in close coordination, is the case for independent central banks overstated today?
I think there's a lot to be said for an independent central bank. After all, what a central bank has to do when demand gets out of control, when there's too much demand, when prices are rising, the central bank has to tighten. And that's not a particularly popular thing to do, to put it mildly. So it's hard for an administration, for a government, it's hard for a parliament or a Congress to tighten policy under those circumstances. So where the independence becomes important is when there is an overheating of the economy and the central bank needs to raise interest rates. So I think having the central bank independent so that it can do that is really a significant and important thing.
How do you view the Asian Infrastructure Investment Bank being promoted by China? Could it one day rival the Bretton Woods twins, and is that what the US fears?
I think the Asia Infrastructure Investment Bank is a good idea. I think it was, there's certainly no doubt that countries throughout the region need more infrastructure. India is a good example of that, but smaller countries throughout Asia need more investment. And the fact that the Chinese were prepared to step up and provide substantial funds for that, and to do it in a multilateral way, to invite in other countries, not just from the region, but from Europe, was all a very good thing. And I think the U.S. looks rather foolish for having said we're against it. I don't think there's any good reason why the U.S. government should have opposed it. And I think it would be nice if they were to say, I doubt they'll do it, but I think it would be nice if they were to say, you know, we've thought about it some more, we've talked to our friends and our allies, we've talked to the Chinese, and yes, we would like to be a party to it.
Are hopes of a reform of the global financial architecture misplaced? After all, there was a great deal of hope immediately after the crisis that we would see some reform, but there's been virtually nothing at all.
I doubt that there's going to be much change in the Bretton Woods twins. I doubt that there's going to be any significant changes in the way those operate and the way they interact with the United States.
How do you see the slowdown in Chinese growth? Is that a net positive or a net negative for the rest of the world?
I just came back from China. I was in China last week, and the people that I spoke with all talked about the new normal. And by that they mean coming down from the old roughly 10% a year real GDP growth, coming down to about 7% where they are now, and probably heading a bit lower before the end of the decade, maybe down to 6%. But they understand that this is because of the changing mix of aggregate demand, the changing mix of industries as they move from the high productivity gaining manufacturing area to services. So they can make that transition without it increasing unemployment in China, because you get more employment per bit of GDP when you're emphasizing services as they now are. So I think that we are going to see a slower growth rate in China, but it's going to be a growth rate and an improvement in the standard of living of the average individual that people will feel more directly, because it will deal with services, with communities, with cities. What we're talking about is not a decrease in the imports of China. What we're talking about is a general slowdown, but the fact that they're moving from an industrial emphasis to a services emphasis means that they will be reducing their imports of certain kinds of products and materials. So if I were in Australia, I would be unhappy at the thought that the demand for iron, the demand for coal, was going to be reduced by the changing mix of activities in China. But overall, I think the slowdown in China is not going to have a generally negative impact on the global economy.
Well, I'm afraid it's time for us to slip into another very short break, Professor Feldstein, but please do stay with us. We'll be back very soon. Welcome back. You're watching Macros with Mythili, and we're trying to make sense of the macroeconomic fundamentals facing the global economy with none other than Professor Martin Feldstein of the US National Bureau of Economic Research. Professor Feldstein, are the troubles in the Eurozone over now? Doesn't the nature of the European Union, in fact, as a monetary but not a political union, limit the success of any unconventional policies like the QE, which is quite unlike what happens in the case of the US?
Well, I've thought for a very long time, even before the Euro officially began, I thought that the Euro was a mistake. I thought the European Union was a good idea, a free trade area for what has now become nearly 24 individual countries, but I thought trying to force all of the Eurozone countries to adopt a single currency, a single monetary policy, a single exchange rate, when the countries are so different in character, different in productivity growth, I thought that was bound to be a mistake, and as we've seen, it has become a mistake. So I think they're going to have a hard time recovering, a hard time getting back to reasonable rates of growth. And while they're now trying a quantitative easing strategy, it's not clear to me that that's going to have anything like the effect that it did in the United States. In the United States, after all, when the Federal Reserve began its quantitative easing, interest rates on long bonds were about 4%. And so it had the effect of driving down long-term interest rates to under 2%, and that in turn led investors to want to invest in equities instead. That boosted the value of the stock market. And it also, of course, those low interest rates led to increased values of individual homes as mortgage borrowing became cheaper. So when you put all that together, household wealth increased dramatically in the year 2013. And I think when that happened, that triggered big increases in consumer spending, that then started the economy shifting from the kind of 2% growth that we had once the recovery began back in 2009 to more than 4%, where it's basically been since the middle of 2013.
If I can now switch to trade, the US is increasingly going in for ambitious bilateral and regional trade pacts that are likely to adversely affect any multilateral trade pacts like the WTO. How do you think countries like India should cope with the consequences of such developments?
Well, I think the real remedy for that would be a stronger bilateral trade agreement, trade and investment agreement between India and the United States. And I think that would provide benefits for both of us. But the TPP, the Trans-Pacific Partnership Agreement, if it comes off, I think will be helpful for the participating countries, and there would be some diversion of trade away from India, So I think it's important, therefore, for India and the United States to talk about what can be done to strengthen trade between our two countries.
Well, we've just seen Moody's revise the outlook for India, but India is still very worried about a rating downgrade. But given that global investors still seem to be pouring money to India, doesn't that seem to suggest that rating agencies have really become largely irrelevant?
Not much, not much. When the United States was downgraded a few years ago, I think our long-term interest rates immediately fell instead of rising. So I think that the rating agencies, as you said, have lost a lot of their credibility. On the other hand, you don't want to be pursuing policies, large fiscal deficits, that cause private individuals, private investors to have doubts about the fiscal soundness of the Indian economy.
My last question to you, Professor Feldstein. What does India really need to do to deliver on its promise? Are we doing enough?
Well, I think that the things that India needs to do are quite clear. I've been going to India at least once a year for, 15 years or so. And it seems to me that the things that the Modi government has spoken about are really very important. Infrastructure, education, improving the property markets so that there's the ability of manufacturing firms and others to access property. I think all of that is really critical if India is going to continue to have strong growth.
Well, I'm afraid that's all the time we have in this edition of Macros with Mythili. Thank you so much, Professor Feldstein, for helping us make sense of all those conflicting, ambiguous data that we see, particularly as far as the macroeconomic scenario is concerned.
Enjoyed talking with you as well.
Thank you also for watching, but we'll be back next week with yet another edition of Macros with Mythili. Till then, it's thank you and goodbye from all of us at ET Now.
Find us on Facebook at facebook.com/etnow and don't forget to click the like button. You can also follow us on Twitter at etnowlive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/etnow.